Hello everyone. In this video, we will continue our discussion or walk through the Excel lecture file for Amazon. So previously, we already input the historical information for Amazon's income statements and statement of cash flow. And also we have already made the assumptions and make the projections for the future income statement and the statement of cash flow. So when we projected the value for the income statements, one part of the model we haven't completed yet, which is the depreciation amortization information. So in this video, I will walk through the depreciation schedule, how we're going to be able to construct depreciation schedule using the information provided by the 10K, 10Q, and what are the certain assumptions or reasonable assumptions that we can make based on the information that we have. Okay. So we will get started by inputting the historical balance sheet information, and then we will move to the depreciation schedule. So for the balance sheet information, I did the same thing to save a little bit of time for this video. I already hard-coded for most value on the balance sheet. I only leave the totals for demonstration in this video. And also there are certain places we do need to make adjustment for Amazon example. So whenever we need to make adjustment on the balance sheet, I leave it blank. I'm going to demonstrate here in this video. But all other things are pretty straightforward. You can just directly hard code it. You get the information that from the balance sheet from their 10K filings. So you see they have the cash equivalent, marketable security, all those values we can directly just plug in there. Once we plug in the assets, current asset value, we can basically just take a sum of all the current asset, and we will be able to derive the total current asset for the past 2 years. And then for the total assets, we just take a sum of the current asset and all long-term or non-current asset, and you will derive the total assets. And again, double check, see if the number match with what's been filed on the 10K report. Let me just quickly take a look. So for the total current asset, our number match from the 10K filings. And then for the total assets value, it match. So that means everything is correct. Then we move on to the current, the liability and equity side. So I will start with the easier one. Since we discussed this in class already, for the shareholders equity sections for most company, you're gonna see there are two separate line of items. One is for common stock, which is the par value. The other one is additional paid in capital. So that's just the actual value that the investor is paying for purchasing common stock. So technically speaking, these two rows represents for the same thing, which is common stock. So when we conduct or create the financial models, we will combine those two lines numbers together. Therefore, what we're going to do here is we're going to using the par value. So this is going to equal to 5 and plus the APAC for 2019, which is a 33,658. And this will give us the common stock value by including both the par value and the additional paying capital. Same logic, apply that to 2020. We're going to use the par value, which is 5, and plus this APAC, 42,865. And we get the common stock value, par value, and the APAC inputted here in the model. And then let's just go ahead calculating the totals for each individual sections, and then we'll come back to these two specific items here. So for the total current liability, we're going to just take a sum of everything inside the current liability sections. And for the total liabilities, we're going to take a sum of the current liability and all non-current liabilities. And of course, at this point, our value should not be the same as the one on the for the 10K filing, is because we haven't plugged in these two values yet. And we can continue our calculations. So let's calculating the total shareholders equity, take a sum of these. And for shareholders equity, our numbers should match with the filing because we already done all the adjustment that we need. So the total shareholders equity should equal to these two value, which match what we have here. And again, of course, the last one, we're going to take a sum of the total liability and the shareholders equity to derive the total value for the right-hand side of the balance sheet. So now we only have two things left. And pay attention to the current liability sections on the 10K report here. We do have accounts payable and we do have accrual expenses and other, and then we do have unearned revenue, but we do not have a short-term debt items explicitly list out on the balance sheet. So this is not really normal for most companies, unless they really don't have short-term debt. Normally, they will list out short-term debt under the current liability sections. So we do need to find a way to separate that for two reasons. First reason of that is because eventually we're going to make projections for other items on the balance sheet for current liability. Specifically, we're going to focusing on the operating current liability. So which means will be the all current liability except the financing related like debt. Because for our later stage, like the discounted cash flow valuation models, when we try to estimate the company free cash flows, we will only use the value related to operating current liability, and we will exclude those like non-operation related, like financing related items like short-term debt. So that's one reason we do need to find a way to separate short-term debt from some items here on the current liability. Apparently, if you look at the three items on the filings, so accounts payable, unearned revenue, they all have their single lines. And the only potential candidates that we can separate the short-term debt from should be this accrual expenses and others. Accrual expenses, of course, those are related to operations. That's the expense that's occurring for you to do your own business. But technically speaking, it should include it in the other sections. We'll double check, but that's one first reason. It's just like for our valuation model, we do need to separate short-term debt from the current liability. Second reason is like, remember in our modeling, we started with the projections of income statements, and then we moved to cash flow statements. So on the cash flow statements, we do have a separate rows under financing activities, which is short-term borrowing, long-term borrowing. So that means like if we have this rows, eventually when we project the balance sheet for future years, you do need to including those numbers into your calculation. If you do not have a separate short-term debt rows, and it's going to cause some confusions once we try to reconcile or solve the values for by including the short-term debt borrowing or short-term borrowing to the balance sheet calculation. Okay, so that'd be the two main reasons why we need to separate the short-term debt from this potential candidates there. If you understand that, then the next question definitely going to be like how are we going to be able to find the short-term debt value. So since we basically gather all those information from the 10K filing, so 10K will be the first resource we're going to use. We can just go ahead and search for keywords. You can do a debt. Try not to use like a short-term debt, because sometimes the companies may not show the short-term debt as specifically as short-term debt. It may call like a current portion of long-term debt or commercial paper, like Apple examples. Those are short-term debt, but not exactly called short-term debt. So try to do a broader keyword search. Let's do a debt keyword search. And of course, there are many options there, but I would say normally the explanation or the detailed notes that explain certain items on the financial statements will be the place that after the financial statement, after the filings shows the financial statements. So you can just keep screening all the potential items there, but eventually you're going to find the place. So now we're at the balance sheet. We know that we should be able to see that specific notes related to that pretty soon. So you just keep going, and normally if on the financial statements or the filings, you should have a specific notes to explain company's debt. And this is very important because we also going to need these informations when we starting to construct the debt schedule. Okay. But now at this point, let's just figure out to see if we have any other information, provided by the filings related to the short-term debt. So by looking at this table, we do have a different like notes debt issuance by different time and different values. And when the company, so basically what this table for is this table shows you that how they actually calculated on long-term debt shows on the balance sheet. And apparently we have all those debts value, and then there's one lines here at the very bottom here. It says like they're gonna less the current portion of long-term debt. So basically how you derive this long-term debt value, we're gonna use all the debt value and subtract the current portion of the long-term debt, which is a short-term debt. You're gonna leave left with the long-term debt. So that means this row will give you the information related to short-term debt. What we can do here, we can just go ahead and plug in those values there. Again, since we, on the filings, they subtract this row, so they list out this as negative value. It doesn't mean that short-term debt value is actually negative, okay? So technically speaking, it's a positive. So what are we gonna do? We're gonna just hard key code it, 1305 and 1155. Before you move back to the balance sheet, starting to make adjustment for other items, you do need to search, see if you've other place that list out the information related to short-term debt. So normally speaking, for the company's filings, we will consider both the debt items and the leasing items are represents for the company's total debt. And that's going to require a little bit more understanding about the leasing part, I would say. For that, it's pretty straightforward. If you do the keyword search, you'll find the information here. For the leasing, you still can do a keyword search, but normally the company will list out the leasing information really close to where they list out the debt. So you see at the note 6, we have the information related to debt. And then if you scroll up a little bit, we move to the note 4. Again, you can do a keyword search. You're going to end up with the same place. But I would say normally the debt notes will be really close to the lease notes. So for this part, note 4, we do have information about the company's lease. I'll explain the basic things about the lease part. Companies do have operating leases and financing leases. It's gonna require different accounting recordings on the financial statements. So if you have a leasing operating leases, it will be recorded as operating expenses. It will not affect the values on the balance sheet. But if you do have a financing leases, it will be recorded as balance sheet items. But when we try to assess the debt values, so we can take both operating leases and the financing leases as a whole, which also represents for some values related to debt. So when we scroll down a little bit, you're going to find out this is the part the company is calculating their long-term lease liability, same logic there. They give you all the leases, including operating leases, financing leases, and then eventually you have total leases for each individual lines there. And then what they did is at the very last, they list the current portion of the lease liability. So that would be the same logic here. What are we going to do here? This is for 2019. And then if you scroll down, you should have lease information related to, scroll up, I'm sorry. You should have lease information related to, this is 2019, this is 2020. So we will have enough information for current portion of lease liability for both years. That means like for 2019, there's a current portion of leases with also related, or you can consider this as a part of short-term debt, is a $13,023 million. And for 2020 is a $14,960 million. So we gonna including these two values for our short-term debt values on the balance sheet. That means we're gonna go back to balance sheet, give an equal sign, use your current portion of long-term debt, and the plus, this is for 2019, so that'll be 13,023. So 13,023. And this should give you or more complete estimations or approximations for the short-term debt for both years. And this one going to equal to this plus the current portion of lease liability total will be 14,960. Okay, now we have the short-term debt done. Apparently, we don't have this in the 10K filings. If you're including this line, that means we do need to make adjustment for other items to be able to end up with the same value shows on the 10K filings. And let's just go back to this keyword search for that. Let's take a look, see if the company provide any notes, explain that where probably those debt will be hidden. So let's continuing to check. Investment. Okay, so you see we do have a line on the current liability side. It's called accrual expenses and other. So the company actually provide a kind of like explanation. What are the things under this accrual expenses and others? So which primarily related to leases and assets retirement obligations, payroll related expenses, tax related liabilities, unredeemed gift cards, customer liability, and the current debt. So you see, they don't call short-term debt, but apparently that short-term debt, which is same as current debt, are included under this accrual expenses and other items shows on the balance sheet. Now we have our like items that we need to make adjustment. We can just basically go back to the balance sheet, find accrual expenses and others. 2019 is a $32,439 million. We know that since we extract the short-term debt already, so let's just hard-coded those number 439, and then we subtract the short-term debt that we extracted from this specific items. And same idea, we're going to use the accrual expenses and others on the filings and subtract the short-term debt. It should give you whatever left for that accrual expenses. So of course, you do need to do a double check. Let's just check after we make the adjustment. This will be the filing current liability value, which match what we have here. So that means we are good and everything is being correctly imported. And then let's just check again, make sure that 87, 812, that is correct. And then how about the shareholders equity value? 62,060. So our doesn't match. So let's just come back here. Apparently all other things are hard-coded. Let's just double check this calculation. So what do we have here? We have 5 plus 33,657. So it should be 33,658. Okay, so this part gives us the discrepancy. And once we have this corrected, you see that our balance check shows our balance sheets are balanced. And that means like our total assets match the total liability and equities. And also our totals here match the 10K filings. We're good to go. Okay. So this is the part we input the balance sheet. The reason we need to input the balance sheet information here is because we're going to move to next step, which is the depreciation schedule. So if we go to the depreciation schedule, I'm going to move this screen to the next one. So get yourself familiar with the setup of depreciation schedule. Basically, eventually, we want to project what will be the depreciation cost for the next 5 years. So first, you need to understand what other things will be depreciated. Mostly speaking, it will be the property, plant, and equipment. And since we're going to make a projections, that means we not only need to depreciate or calculating depreciation for existing PP&E, we should also calculating what will be the new depreciations based on our new purchase on the fixed asset, which specifically tied to the expenditure projections we made on the statement of cash flow. So first, let's link the existing PP&E value for 2021 back to the balance sheet. So apparently, we don't have this net PP&E projected for 2021, but remember, everything shows on the balance sheet is the year-end value. So here, specifically for the depreciation schedule, this specific sale, this actually is the PP&E at the beginning of 2021. So the beginning value should match the ending value from previous year. Therefore, this is going to link back to the balance sheet, net PP&E for 2020. So this gave us the fixed asset value for the existing fixed asset values when we started in 2021. Then how about the capital expenditure? So remember that if we go back to the statement of cash flow, we already make the projections. This is how much extra money we're going to spend on the PP&E. So this will be your new PP&E value. So basically what we can do here, we're going to just link this row from the capital expenditure. But you do need to make one adjustment here. Once we link that, you're going to realize this is negative value. This is true for the statement of cash flow because we spend money that's going to be a use of cash is supposed to reflect as negative value on the statement of cash flow. But the actual value of the PP&E should be positive because that's how much the new fixed asset is going to worth. So what we're going to do is we're going to just give a negative sign to make it positive. And then you can basically just copy that. So all of these should match the values that we projected on the statement of cash flow. Now we have one thing or one major factor we needed to construct the depreciation schedule, which is the existing and the new PP&E value. Then we need to figure out what is the depreciation method that the company is using and whether the company provides you some information related to the useful life of their fixed asset or PPAE. So now what are we going to do here? We're going to come back to the 10K filings. Let's just check depreciation, see if we can find any information related to depreciation method and the useful life for the existing PPAE. So we total have 18 search result here. Let's just screening all of that. Again, make sure that you understand what we're looking for. We're looking for the company's explanation on the depreciation method and also the useful life for their PPE. So if you recall that previously, when we tried to figure out the depreciation values or expenses hidden by certain items on the income statements, we already did keyword search. Basically, at the beginning, couple search results should give you some just information related to where you can find it or where the depreciation expenses had been hidden under certain operating expenses. But let's just take a look here. This is use of estimate and technology contents, G&A. Okay, so this sections, when there is a sections the companies explain the property, plant, equipment net, we do have a certain information that we need for this depreciation schedule. First of all, we do see that the companies showed you that the depreciation amortization is recorded on a straight line basis. So basics means that the depreciation method they're using is straight line method. And then they do give you some estimated useful life for their existing assets. So 40 years and the remaining life for the buildings, 3 years prior to January, 4 years subsequent to January 2020 for the server, 5 years for networking equipment, 10 years for heavy equipment, and the 3 to 10 years of other fulfillment equipment. So it looks like we do have a specific information related to useful life for specific categories of fixed asset. But since we do not have the values also separately listed for those like existing PP&E, so we know that we have to do approximations on the useful life, and whenever we construct the depreciation schedule, we're going to just take the PP&E as a whole. So, but for whichever the company you analyze, if you end up finding out you do have information, like for example, related to building, then you should use 40 years for buildings. And if you have information about the server, you should use 3 or 4 years. If you have a net working capital equipment value, so you can use 5 years. But for our projections, if you recall, the capital expenditure basically on the statement of cash flow, this just tells us like in total how much we expect to invest into PP&E. So it's going to be hard for us to project the depreciation or estimate depreciation separately. But it doesn't mean that we cannot do that. It's just like we have to do approximation here. So let's just take the information we have here. Apparently, for all the PP&E that Amazon is having, their useful life is ranging from like the lowest one would be 3 years all the way to 40 years. So we can actually use that information to get started with our depreciation schedule. Again, first, we know that the company is using straight line method. So that means like once we have the useful life, let's just make it up. If the useful life is 5, then we basically can just use this specific value for the PP&E divided by useful life. It will tell you like how every year how much depreciation is going to be. If it's different depreciation method, it's going to apply that to different ways to solve the depreciation. But the straight line is pretty straightforward to calculate it. Now we know that useful life, the 10K filing given is between 3 to 40 years. 3 to 40 years. So what we can do, you can put 3 years, 40 years, and or you can get started, just take a midpoint. Let's just do 20 years for the existing one. And you see that we do separate the useful life for the existing PP&E and the new capital expenditures, because you may end up, like technically speaking, if you do, let's just using a specific example, if you buy a new building, of course, the new building going to have a different useful life than your existing building. So it will be reasonable, or logical to separate the useful life projections between the existing PP&E and the new capital expenditure. So let's just make it up for like 20 years for both existing and the new purchase. Then we can starting to set up our calculation for depreciation, and then we will come back to make adjustment. I know this 20 years may sound like a pretty random number we throw in there, but there are ways that we can come back to make adjustment, and we can assess that using the information we have. Okay. So now, once we plug in the useful life, we know there will be a straight line. So that means each year the depreciation is going to be the same. So what we can do, we can go ahead calculating depreciation for each individual fixed asset or PPAE. So starting with the existing one, we're going to use the existing one. Let's just anchor that because every year going to be the same. Divided by useful life, we project it here. And then we can just go ahead and fill right. That means like for our existing PPAE, we project that these will be the depreciation expenses each year for next 5 years. And then we do the same thing for the new purchased PPAE. You purchased this amount in 2021. We're going to use that. We're going to anchor that. But now we divided by the estimation for the useful life of capital expenditure, the new purchase. And same idea, we're going to just fill right. And this represents the depreciation expense each year for your 2021 new purchase, the PPAE. For 2022, of course, you don't have that in 2021 yet. So that's why these are grayed out, these sales. So 2022, we're going to start it from this one. That's going to be 2022. We anchor that divided by useful life here. And we're going to just go ahead and fill right. 2023, same logic. Let's just anchor that divided by this 20. I know in class I showed you there is another way you can use the SLN function because that's the straight line depreciation calculation functions in Excel. So that's the same. You should end up with the same result. The cost for this year is going to be this. Let's anchor that. Salvage value equal to 0 because we don't make assumptions for salvage value. We don't know how much exactly those a new purchase going to be sold for in the future years. So let's just leave it blank or 0. And then useful life, we're going to link back to this assumptions there. And we can go ahead and fill right. And the last one, let's just use SLN again. We have the cost, comma, salvage equal to 0, comma, useful life 20, close to parenthesis. You don't have to anchor anything because we're not planning to copy this formula over. But if you do have more years, then we're going to just anchor both the useful life and the projected capital expenditure. Once we've done that, we can basically just go ahead, sum these together. We get the depreciation projected. So remember, after you've done this calculations correctly, now this is not done because we know that we kind of randomly throw in the numbers. Although this is falls in the range between 3 to 40 years, but still the range is too wide. This seems like two random assumptions. So how are we going to be able to project or what will be the reasonable projections for depreciation? So this is going to need you to go back to the previous year's depreciation, try to assess what is the change. So now let's just add in some values here. So we have previous year will be 2018, 2019, and 2020. And we're going to project 21. So let's just use 2021 as examples here. And we can go back to the income statements, linked depreciation that we inputted there. And then let's just link this one we projected here, okay? Next, we can assess like how did the depreciation change? Apparently, by just looking at the number, we see that depreciation increasing year over year in the past 3 years. So that should starting to tell you that probably this 8,376 is not a reasonable number because based on the historical trend, we should expect to see increasing depreciation. And another reason this might not be a reasonable number is because you're only going to see one scenario or a certain scenario that depreciation is decreasing is when you're starting to, to selling your property, plant, equipment, or scale back your investment. Or technically speaking, if you see a decreasing depreciation, that means pretty much you don't purchasing additional fixed asset anymore, and you're starting to sell the existing fixed asset. That's where you're starting to see depreciation going down. Okay, with our assumptions on the capital expenditure, we expect that we're going to continue to invest money into the fixed asset. So you should expect to see the depreciation increasing compared to the previous year. Okay, but now let's just first calculate the growth rate. This divided by previous year and -1. And let's go ahead and write, and let's convert it to percentage. So apparently from 18 to 19, it's increased by 42%, 19 to 20 increased by 16%. So apparently, if you compare these two numbers, 42% increasing might be too aggressive. But again, there's no right and wrong answer here. But at least that we know that for sure we should expect to see an increase here. So what we can do here, we can just continue to calculating the changing rate. So you see that if we gonna stay with our projections here, so basically last year the depreciation is increasing 16%, and this year we're gonna expect it to decrease by 66%, which technically speaking, without knowing that specifically or without knowing that for sure, this number is just like is not logical. So we can starting to test our assumptions in the for the useful life here. Which one to get started? It depends on which year you're at. Apparently, we started with this year. So this year, you take a look at the values here. This year, the existing PP&E depreciation takes the most part of the depreciation of this year. So that means we're going to start it with adjustment for the existing PP&E useful life. So which direction to go is you can just double check. If you increase that, of course, you're going to see the depreciation is going to be decreasing. It's just remember, we divided this value by this. So if this denominator going up, your total value going to going down. So that means we have to starting to reduce the useful life assumptions there. Instead of doing 20, let's just change it to 10. So even change it to 10, you see that we still have a decreasing depreciation. And then let's just change it to 5. So when we change to 5, it's increased. Now it becomes a positive growth rate, meaning that we're going to increase by 0.3%, 37%, which is significantly lower than both past the two growth rate. And you can continue to adjust this to 4 years, and they may give you reasonable numbers. But remember that we haven't adjusted the capital expenditure yet. And also, if we adjust this to 4 years, it's pretty close to the lower end of our range, which is 3 years to 40 years. So it might be too aggressive. Let's just stay at 5 years. And don't forget, we still can adjust this capital expenditure for the useful life for the new purchase of the fixed asset, which is the capital expenditure. So again, we're going to adjust this to 10 years. And now we're starting to see this bump up, and it's going to be increased 11%. If you see that, well, if you say that, oh, I don't think the 42% is reasonable to be sustained, then maybe 16% is more reasonable. Then apparently 10 years is not going to lead you to that 16% increase. You can continue to drop this to 9 years. It's still not 16% yet, but maybe at this point you are satisfied with this. Okay. But before making the conclusions here, actually, there's other things we can check. Remember, when the author write the book, actually the 10K has already been filed, and also the first quarter earnings had already been filed. So we can check what it will be the quarterly earning that imply the depreciation. So let's just do 2021. First, let's go to MECC to find the 2021 first quarter filings here. Not this one, I'm sorry. This will be the first quarter for 2020, fiscal year 2021. So now what we can do is let's just go to the financial statements. We can find the depreciation, which is on the statement of cash flow. So on the statement of cash flow, we do have two big columns, separate columns here. One is for 3 months, one is for 12 months. So 3 months is pretty easy to understand. We are at the quarterly earning, and this is the first quarter. So that means this will be the depreciation and amortization cost for the first quarter of 2021. And for 12 months, basically, we're just calculating or just give you the information about the trailing 12 months, meaning that for 2021, this is just equal to last year depreciation amortization, subtract last year first quarter, and then we adding this year first quarter to derive the trailing 12 months depreciation. Okay, we're going to learn a little bit more about this calendarization adjustment later on, but at least make sure that you understand that this basically gave you the past 12 months depreciation amortization. This just gives you the past 3 months. And remember, for our model here, we are dealing with yearly, which is 12-month information. So let's just type in this like so we have a 3 months, we have a 12 month. So for the 3 months, we can just hard code it here. 3 months going to be 7,7508. 7508. And then 12 months gonna be 27,397. Okay. So why we need this value? Because this is already happened in the first quarter. So maybe instead of using the past or historical growth rate, now we can starting to assess what is the, based on the quarterly earning, what is the growth rate for the depreciation. So if we use this 12 months, which means like we can directly compare this because this is a full year depreciation. So we can calculating the growth rate by using this 12 months divided by 2020 depreciation minus 1. So that means like if this is what you believe should be the depreciation based on the first quarter earning, then the depreciation this year is going to increase by 8.5%. Then how about if we want to use the 3 months value? So for this one, we do need to make an adjustment. We need to convert it to a year. This is 3 months. There are totally 4 quarters. Let's just simply use this multiplied by 4. And then let's calculating the growth rate based on this one compared to 2020 depreciation, subtract 1. So you see that based on the first quarter depreciation filings, we kind of like find out like based on this first quarter information, the growth rate for the depreciation or the implied growth rate for the depreciation is falls into between 8.5% and 18.93%. Okay, so compare this. Now let's come back here. We end up with this 13.5% by using 5 years and 9 years, which falls inside this range. And you can continue to decrease this even further. 8 years is going to give you this number pretty much, a little bit higher than the previous year growth rate, but falls in the range that implied by the 10Q report. So this is the step or the stage. It's really going to just require your own assumptions. As I said, there's no right and wrong answer. So what the author eventually chose is the 9 years. 9 years is because, we know that different years going to give us the numbers. First, we do want the growth rate falls in this range because this is implied by the quarterly earning. But then this 9 years is going to give us like a 13, which roughly speaking falls in the midpoint between these two percentage. But again, there's no right and wrong answer. But in order to match this demonstration solution with the book, so I'm going to just use 9 years. But make sure that you understand the logic here. As I said, there's no right and wrong. You don't even need to use the first quarter, but you do have that information. I mean, this is the most updated information you have. Why not use this one? But even you use this one, if let's say I just want to stick with 12 months, which gave us like 8.5%, apparently 9 years, it may be too aggressive. We can change it to 11 years. So this will give you a rate close to this one, which is also fine. Okay. But again, I'm going to switch back to 9 and which gonna gave us the implied depreciation growth rate for 13.54%, which falls in the midpoint that implied by the growth rate of implied the growth rate by the 10Q report. Okay, once we got this done, of course, now we can starting to link things back to the income statements. Depreciation amortization is equal to depreciation amortization we projected here, and then double check that on statement of cash flow. Remember that we try to link things as often as possible. So that means you do see depreciation on the statement of cash flow, but now we do not have to link that again to the depreciation schedule because we link this directly coming from income statements. Once you got the income statements done, this one should automatically pop up. And of course, everything changed on the statement of cash flow. And this will complete the discussion for the depreciation schedule estimations. So next step, we're gonna moving on to the working capitals, and then we're gonna project the balance sheet, and eventually we will project or create the debt schedule to complete the model. Okay, so this is it for this video. Let me know if you have any questions, and bye.